This video covers Komatsu's financial results for the first quarter of fiscal year 2025, for the period from April to June 2025. Komatsu is a Japanese manufacturer of construction, mining, forestry, and military equipment, as well as industrial machinery. It is the world's second largest construction equipment maker after Caterpillar. For the first quarter, net sales decreased by 5.2% year-on-year to 909.5 billion yen. Operating income fell by 10.6%, with the operating income ratio declining by 1.0 percentage point to 15.4%. Net income also dropped by 16.9% to 91.2 billion yen. The results reflect the impact of the stronger yen, which affected both sales and profits, despite some offsetting factors like improved selling prices. The progress rate against the full-year net income forecast of 309 billion yen is 29.5%, which is at least in line with the company plan. Segment sales and profit. In the first quarter, Komatsu's consolidated net sales declined by 5.2% year-on-year to 909.5 billion yen. The construction, mining, and utility equipment segment saw a 5.5% decrease in sales, while its segment profit dropped by 14.1%. The decline was primarily due to foreign exchange effects, although improved selling prices helped offset weaker sales volume and increased costs. In the retail finance segment, sales were essentially flat, but segment profit rose significantly by 22.5%, supported by reduced procurement costs. The industrial machinery and others segment posted a 4.6% decrease in sales, mainly due to weaker demand for large press machines. However, segment profit grew by 43.5%, driven by increased sales of high-margin Excimer laser maintenance services. As a result, Komatsu's total segment profit for the quarter decreased by 10.6% to 140 billion yen. The overall profit margins also changed across segments, with construction, mining, and utility equipment's margin falling by 1.4 percentage points to 14.5%, while retail finance and industrial machinery and others improved to 30.8% and 16.6% respectively. Regional breakdown of sales for the construction, mining, and utility equipment segment, which is the biggest business segment of Komatsu. Total sales to external customers in this segment amounted to 842.3 billion yen, marking a 5.5% decline compared to the same period last year. The sales decrease was largely due to the negative effects of foreign exchange rates, totaling approximately 49.7 billion yen. On a real basis, excluding currency impacts, sales fell slightly by 0.1%, or 0.7 billion yen. Regionally, sales dropped in North America, Latin America, Africa, Europe, and the Middle East, with the sharpest decline seen in North America at 38.1 billion yen. Meanwhile, sales increased in Asia, Oceania. Japan and China remained roughly flat. The data indicates that although foreign exchange was a major factor in the overall sales decline, demand in most regions other than North America remained relatively stable. Latest estimated impact of additional U.S. tariffs. Based on the tariff measures announced by the U.S. government as of July 24th, Komatsu estimates that total tariff-related costs will decrease by 30 billion yen on a payment basis compared to the previous forecast made in April. Additionally, the negative impact on profit and loss is expected to be reduced by 3.5 billion yen. Despite these changes in cost estimates, the company has not revised its overall outlook for full-year demand, sales, or profits due to the tariff policy. The reduction in tariff-related costs is attributed to changes in tariff rates and possibly successful negotiations between countries. The graph on the page visually shows that the estimated cost impact has been revised down from the April forecast, particularly in terms of inventory-related tariffs and reciprocal duties. Projection for fiscal year 2025. Komatsu has not changed its projection for the year since the previous announcement in April. Komatsu expects net sales of 3,745 billion yen, which is an 8.8% decrease from the previous fiscal year. Operating income is projected to decrease by 27.3%, and net income is forecast to fall by 29.7% to 309 billion yen. The expected operating income ratio will also decline from 16.0% to 12.8%. Komatsu plans to maintain the same cash dividend per share as last year at 190 yen, but the consolidated payout ratio is expected to rise from 40.1% to 56.7%. These figures reflect the impact of weaker foreign exchange rates, as the company assumes lower yen exchange rates against the US dollar, euro, and Australian dollar compared to the previous year. Stock price. This is the Japanese yen-based chart for the last 1 year. The Japanese yen stock price is 5,022 yen as of July 29th, and the US dollar stock price is $33.86 as of July 29th. Following the agreement on tariffs with Japan under the Trump administration, the stock price initially surged sharply, but then plummeted again after the earnings announcement. It seems the market viewed the earnings forecast as weaker than consensus expectations. Current PBR is 1.48 and PER is 14.9. Dividend yield is 3.78%. Although the stock price has declined, it remains at a relatively high level compared to the past when viewed over the long term. In terms of PBR and PER, the current stock still appears expensive compared to recent years. However, the dividend yield is now higher than before, thanks to continuous dividend increases. Conclusion. Komatsu's first quarter results for fiscal year 2025 showed year-on-year declines across key metrics, mainly due to the impact of a stronger yen. While core segments like construction, mining, and utility equipment saw reduced profits, the retail finance and industrial machinery segments showed resilience with improved margins. Despite reduced tariff-related cost estimates, Komatsu has kept its full-year forecast unchanged, anticipating a significant drop in revenue and profit due to currency effects and softening global demand. Komatsu at least aims to maintain its dividend amount, even though the projected payout ratio is higher than before. Due to the impact of the Trump tariffs, it is still hard to have a clear outlook for the rest of the year.